$65 billion. That's what the account statement said, thousands of them, mailed out every month to charities, celebrities, banks, and retirees. Every number on every one of those statements was fiction. There was no 65 billion. There were no investments at all. This is the story of Bernie Madoff, the biggest Ponzi scheme in history. It ran for decades. It survived government inspections. It fooled some of the most sophisticated investors on Earth. And here's the part that should keep you up at night. The math needed to catch him wasn't complicated. One analyst reportedly saw the numbers and knew it was a fraud within minutes. So how does an obvious lie survive for decades in the most regulated market in the world? Open the file. First, the machine itself, because a Ponzi scheme is much simpler than it sounds. Imagine I tell you I'm a genius investor. You give me $1,000. I don't invest it. I put it in a drawer. Next month, someone else gives me $1,000. I take 200 of their money and hand it to you as your profit. You're thrilled. You tell your friends. They give me money too, and I use it to pay the earlier people. That's the whole trick. There's no investment. The returns are just newer victims' cash flowing backward to older victims. It's named after Charles Ponzi, who ran the same con back in 1920. And every Ponzi scheme carries the same death sentence, written into its own math. It must grow forever. The moment more people ask for their money back than new money coming in, the drawer is empty, and the whole thing collapses in days. Madoff didn't invent this. He just ran it bigger, longer, and more politely than anyone in history. Here's the thing about Madoff. He wasn't some shady stranger with a hot tip. He was the establishment. He founded a legitimate, respected trading firm. He served 3 terms as chairman of the Nasdaq Stock Exchange. He sat on industry boards, advised regulators, gave to charity. When the people writing the rules needed advice, they reportedly called Bernie. And then he added the genius touch. He made it hard to give him money. You couldn't just invest with Madoff. You had to be introduced. You had to know someone at the country club, the charity board, the synagogue. People reportedly begged for years to get in, and some were turned away, which only made them want it more. Think about what that does to your brain. A scammer who chases you triggers alarm bells. A scammer who rejects you? You chase him. Exclusivity flipped the psychology of the con. The victims did the selling for free. And because his early clients came heavily from his own tight-knit community, trust was pre-installed. But what was actually happening to the money? This is the part people can't believe. Madoff's investment strategy, the one he described to clients with confident jargon about options and blue-chip stocks, involved zero trading. Not bad trading. Not risky trading. None. Every dollar went into one big bank account. When clients wanted a withdrawal, money came out of that same account, other people's deposits. The evidence of investing was manufactured in-house. A small staff on a separate floor reportedly generated fake trade confirmations and fake monthly statements, typing in trades after the market moved, so the numbers always looked plausible. It's easy to buy low and sell high when you're writing fiction in the past tense. And the returns he printed were beautiful. 10 to 12% a year, almost every year, through booms, busts, and crashes, with barely a losing month. Not spectacular. That's the craft. 50% returns attract auditors. 11% every single year attracts pension funds. It looked boring, safe, institutional. There was just one problem. For anyone who actually understood markets, returns that smooth aren't a green flag. They're a mathematical impossibility. In 1999, a quant analyst in Boston named Harry Markopolos was asked by his bosses to reverse engineer Madoff's strategy. Basically, he's beating us. Copy him. Markopolos looked at the return stream and reportedly concluded within minutes that it was impossible. The strategy Madoff claimed to use mathematically could not produce that line. Nothing legal could. One of his checks was almost embarrassingly simple. For the strategy to be real, Madoff would have needed to buy more options than actually existed on the entire exchange. The market wasn't big enough to contain his lie. So Markopolos did the right thing. He wrote it up and submitted it to the SEC, the government agency whose entire job is catching this. Nothing happened. He submitted again and again. In 2005, he sent a memo literally titled, "The world's largest hedge fund is a fraud," listing 29 separate red flags. The SEC did examine Madoff more than once over the years and cleared him. Investigators reportedly asked Madoff questions. accepted his answers, and never made the one phone call that would have ended everything, asking the clearinghouse to confirm his trades existed. They didn't, because there weren't any. The fraud wasn't hidden. It was ignored. Madoff was too respectable to be guilty. Remember the death sentence written into every Ponzi scheme? More money out than in, and it dies. In 2008, the financial crisis hit, and terrified investors everywhere needed cash. Madoff's clients, through no suspicion of him at all, started asking for their money back. Billions in redemption requests piled up against a drawer that was nearly empty. No new money could come in fast enough. The math had finally arrived. In December 2008, Madoff reportedly confessed to his sons that the entire business was one big lie. They turned him in. He was arrested the next day. The paper losses, around $65 billion. The actual cash investors put in and lost, roughly 17 to 20 billion, still the largest financial fraud by one person in history. He pleaded guilty and was sentenced to 150 years. He died in prison in 2021. And the victims weren't hedge fund sharks. They were retirees who lost everything, charities that shut their doors, families wiped out overnight. So what's actually in this file? Not a story about one monster. A story about wiring yours. Madoff exploited 3 switches that exist in every human brain. 1. Affinity. He farmed his own community, where trust is the default. The person most able to rob you is the one you'd never check up on. 2. Exclusivity. When something is hard to get, your brain stops asking, is this real? And starts asking, how do I get in? Only one of those questions protects you. 3. Consistency. Returns with no bad months aren't a sign of genius. They're a sign of fiction. And notice what didn't protect anyone. Credentials, reputation, smart friends already invested, even government inspections. Social proof just means other people skipped the homework too. So the takeaway is one question. The phone call the SEC never made. Can a third party independently confirm this exists? The biggest fraud in history didn't hide in the shadows. It hid behind a handshake, in plain sight. If you want to know how money games like this actually work and how to see them coming, this is the channel for it. New file every week. I'm the Money Files. See you in the next one. Case closed.